You are one of the most bullish voices that I've heard over the last 3 or 4 weeks, and I'm really relieved to have you today.
Thank you, Niraj. My pleasure as well to be on ET Now this morning.
Well, yes. And why this bullishness, Ridham? Almost everybody is skeptical about what the markets will do because of the global setup, and of course locally the earnings haven't picked up as well. Why is it that I'm seeing you sounding so bullish?
See, Niraj, I think we are now typically dealing with a very tall wall of worries. Whether it is the fact that the RBI may not be cutting rates, or whether it's the fact that growth has been tepid, or global cues seem to be all over the place. This is exactly the time when equities, become more attractively valued, and it's the time when you buy equities, you actually make more money. When everything is good and people are all bullish, of course, as we realized now for the upteen number of time, you don't make money. So when you were buying equities in February, it wasn't the ideal time from a short-term perspective. Indeed, from a long-term perspective, we have remained constructive, and I think investors should stay engaged in equities. But I think from a 6-month perspective as well, equities are getting more attractive. That doesn't mean that there's no downside to this market. There could be some more, especially because global cues, I think, look very challenging. But I think that may prove to be a good point to enter if I look forward, say, 6 or 9 months, because I think India's growth is likely to turn in the next 3-4 months. So that's why I'm constructive.
Ridham, but what's the mood like at the conference? Are investors a little cagey about the recent correction that we've seen in India? More importantly, in light of China outperformance and an impending rate hike, it must be getting people a little nervous about whether to deploy money into India right now or not.
So there are three parts. There are three parts to your question. So as far as our summit is concerned, the attendance is over 400 investors. It's as good as it's ever been. I think it's as good as 2009 when we had a lot of investors come in. In fact, last year as well, when we had over 400 investors. So clearly this summit in terms of attendance of investors from around the world is no short of our previous highs. So there is a lot of interest in India. Are investors a bit more wary? Yes, of course they are, because the markets are down. Stock prices are not behaving nicely. And that always scares investors. Investors like to see rising share prices, even if they are long-term investors. And a lot of people who are momentum investors obviously don't find India attractive right now because momentum is elsewhere. On the third point that you mentioned about China's outperformance, I don't think the two of them are linked. Of course, we'd like to see it that way, that China went up and India went down. I think the pools of money that come into India and China are quite distinct. If anything, probably some of that money has come out of Japan rather than India. If you see over the last 5 years, long-term investors have been continuously buying India, and that has not changed in great deal over the past 3 or 4 months also. Maybe at the margin, some of the momentum investors may have escaped the market and gone to other places like China, but the long-term money is still very much perched in India. So to the three parts to your question, I think investor interest in India, extremely high. Investors are certainly a bit more wary. They'd like to see share prices stabilize, especially the ones who look at the markets from a short-term perspective. And I think the China factor is not such a big deal for India.
Ridham, Nikunj Dalmia also joining in. So, Ridham, crux of your argument is that Indian economy will recover. We may be 3 quarters or 4 quarters away from economic recovery, but economic recovery is coming. So, my question to you is that what will lead the economic recovery? In the last cycle, the economic cycle, the capex cycle was led by metals, power and the infrastructure sector. For the moment, these 3 big sectors they've already gone bust. So why will the economy recover, and how will the economy recover?
Firstly, I don't think the economic recovery is 3 to 4 quarters away. I think it's much closer at hand. I would say it's 3 to 4 months away. I think in 3 to 4 months, we should see visible signs of a recovery. In fact, some of the leading indicators that we track are already turning. So let me cite them for you. The first one is CapEx. So CapEx is already turning, led by government expenditure in infrastructure. So you asked this question about infrastructure. Well, it's not the private sector that's going to come, and it's the private sector that is in pain. It's the private balance sheet that is in pain, but the government balance sheet actually is okay. And the government has started spending on infrastructure. If you look at what the government is budgeting, it's for a 30% rise in investments. Maybe we don't get all that 30%, but we're still going to see a substantial part of it, and we're already seeing that. So when we aggregate the capex numbers, we are seeing a recovery. If we see new project starts, we're seeing a V-shaped recovery. So that's the first leading indicator. The second one is real M1 growth. That tells you the transaction volume in the economy. That number is now in double digits. It's at a 5-year high. And it leads all other economic indicators by 3 to 6 months. It leads corporate revenue growth by about 3 to 4 months. So that has also turned. And the third indicator for you to look at is essentially what's happening to, say, something like car sales. I think urban consumption is picking up, and we're getting various signals from various components of urban consumption that the urban consumer, who was reeling under falling real wages because of high inflation over the last 4 or 5 years, is now coming back because inflation has gone down and his real wage is rising. So these are the three key drivers. I think we're getting scattered evidence right now, and I think the evidence will get more and more robust as the next few weeks pass by. So I don't think it's 3 to 4 quarters. I think that would be too long a wait. My own belief, it's probably about 3 to 4 months away before we see more broad-based indicators turning around.
Your answer, but I have a follow-up question, which is that who will fund the recovery? PSU banks don't have the capital. Private banks, frankly, they do not want to lend to the infrastructure sector. So where will the cash come from?
Lending growth or credit growth is actually a lagging indicator. It comes a lot later. In the initial stages of an economic recovery, bank lending growth remains tepid. The good news here is that credit growth has, or I would say deposit growth has exceeded credit growth now for several months, which means that banks' balance sheets are getting more liquid. That sets the stage for the next credit cycle. But if you ask me, I think the next credit cycle is probably 9 to 12 months away. It's not on hand. The funding of such capex will largely come from the government balance sheet, which is what I expect over the next few months. And then when that accelerates and economic growth starts improving, then credit growth will start improving. Now, with respect to your question on PSU versus private, I think it's fairly apparent that PSU banks are running short of capital. We wrote a detailed research note about it yesterday, and that it is the private sector banks that will gain share. Of course, I would highlight that there is a risk here to this story, and there are a couple of risk factors, and one of the risk factor is that the PSU banks, which are about 75% of the system, are running short of capital, and therefore they can be an impediment to a much stronger recovery later in the cycle, or later say in the next 12 months. And if those PSU banks don't get fixed, then there is a possibility that they may act as an impediment to a stronger recovery. So that, I think, is a risk factor we must bear in mind. But very clearly, I think private banks are likely to gain share over PSU banks. They are much more well capitalized. And don't look for credit growth to turn around, at least for the next few months, because that is a lagging indicator.
Ridham, I'm looking at the SCED for the conference. It's got an infrastructure panel, a power panel, a trip to visit Pune industrials, and a cement trip. Very interesting. Is there more to read between the lines? Are these the sectors where growth would come in fastest, or are they the ones which are in need of funds?
No, these are the two. So private banks and industrials are our two biggest overweights. We do think the time has come for investors to look at industrials. We run into a lot of skepticism from investors. They're still not convinced, and I think this conference will give them a lot of evidence from the ground that things are starting to change. So a bunch of events are lined up in order to produce that evidence. I think the evidence will still be scattered. It's unlikely to be very strong, but I think there will be some evidence that things are turning.
2 points rolled into a question. What's the composition of the investors who are featuring right now, Ridham? Because your note clearly states that the next game changer for Indian equities would be the large participation of DII money coming into play as opposed to FIIs. Are there a lot of DIIs who are featuring out here? And do you yourself believe that that's the large crux of money that will come in the next 6 months, which will lead to the market recovery as well?
So Niraj, see, flows follow prices. They don't lead prices. So we should not try to forecast flows. We should instead try and forecast prices. And if prices are going to go up, then the flows will follow. So flows are a slight lagging variable. They're not a leading variable for prices. I know we do a lot of work on flows, but beyond the short run, flows are basically a lagging variable. Now, as far as our view on domestic households is concerned, it's a slightly longish story, but I'll still dwell into it because I think it is a very important one. And it's one of the themes or one of the anchors to the India story over the next few years. So I think the domestic investor was scarred and scared after the scams that happened in the 90s, starting with the Harshad Mehta scam. A lot of money was lost in the equity markets. We went through a decade of very low returns, in fact negative returns at most times. And investors went away. They didn't come back. They came back to trade the market, maybe during the tech bubble or during the previous bull market, but just to trade it. They didn't really come to invest. I think a whole generation has passed now. The generation that got hurt by the scam is gone. We have a new generation at hand. People who don't have memories of the scams of the early 90s and the losses of the early 90s. What they are instead looking at is an asset class that has actually delivered very strong returns over the last 3-4 years. It has beaten almost everything that they own right now, whether it's gold, property or fixed deposits. And it seems to offer a lot of promise because of the macro changes that India is going through. Together with that, we have support from demographics, young people who are willing to take greater risk. But there's one big behavior change that has happened over the past few years, which I think is of great note here. I think consequent to a lot of effort from the regulator and therefore focus on investor education, we're seeing this huge shift towards systematic investing. So investors are no longer trading the market, they're parking a fixed sum of money from their monthly income into equities. And I think that is exactly the behavior we would want from the retail investor. We don't want him to be punting in the market. Timing this market is very hard for retail investors. It's very hard for me. It's very hard for you. So it's not anybody's game. And therefore, people who are using their or investing their hard-earned money should be investing it on a systematic basis. And that's exactly what they're doing. SIPs have climbed up nearly 5-fold in the last 4 years. So I'm seeing a behavioral change. I'm seeing positive real rates. I'm seeing a new generation looking at equities, and that gives me confidence that we are probably at the throes of a super liquidity cycle in which we will see surprisingly good flows from domestic investors. You know, in the last 12 months, domestic households have already put almost $15 billion into equities.
True.
Only through mutual funds and probably separately some directly into the market. That's actually more than what FIs have brought to the market.
True.
And I see that trend continuing over the next decade or so. So we are actually forecasting nearly $300 billion, a
Right.
6-fold increase in domestic saving. So I think this is a story which will hang around for a while. Of course, it doesn't impact the mix of our conference attendees, because remember, right now, foreign investors still have a dominant share in flows as well as in ownership. So they obviously dominate our conference as well.
Yeah, well, which is a fair point. Okay, Ridham, final question from my end. I understand we have to let you go, but just you would understand this better. The MSCI rejig that will come in today, or might not come in, but let's assume that for argument's sake that China shares do get included in the MSCI emerging market index, mainland China shares. Does it have an impact on flows into India? Because the opinions are divided out there. Some people say that overall EM weightage will go up, and therefore it's not that flows will go out from countries like India into China. What is your assessment here? See,
I think there are some weightage changes that could happen. Now, I cannot comment on this because we do not know the exact nature of the impact. But some portfolio rebalancing does happen around MSCI. More importantly, actually, investors anticipate these changes and trade around them. So we did a lot of work around index changes, and what we find is that bulk of the gains or returns are made before the index change actually happens, and then they wane after the index changes. So investors or market participants tend to anticipate these changes. So I think some of these changes may already have taken place, and after the announcement, it's a typical old market adage, right? You buy the rumor, sell the news. So I think the news then loses its value very quickly. So again, not knowing what the changes are, I cannot give you a detailed comment, but we'll have to wait and watch the significance of the impact. There will be some impact, of course, for sure.
Ridham, always good chatting with you. Thanks much for taking the time out, and have a good conference.